Hey everybody, what's up? It's Thursday, March 25th. Almost done with March. Wow, next week already into April. Weather's starting to get nice here in New York. A lot of people walking around, everybody at restaurants. I don't know how it is where you guys are, but New York City activity definitely picking up. And the market bounced back today. We were lower early and we closed up. I think today could be maybe the bottom of this correction. One thing interesting in the AAII weekly sentiment survey, very high levels of bullish sentiment were evident. As a matter of fact, it was the highest bullish sentiment since the week of November 19th, 2020. And also very low levels of bearish sentiment. Now, ordinarily, if you look at that thing, you know, that would be kind of a caution sign as to maybe a further pullback in the market. It's interesting, though, because bullish sentiment has been rising for the last 3 weeks steady, even though the market's been coming down. So very likely that the sentiment optimism might be due to the stimulus checks that people are getting. I don't know, because I'm not seeing the same kind of pattern in put-call ratio. Put-call ratio has been rising, not sharply, but it's been rising. So at least in the options markets, seems to be some more caution, which would be expected with this market pullback. Anyway, fiscal, man, another almost 40 billion went out yesterday. We are 1.04 trillion over same time last year. That's 1.04 trillion in additional spending over where we were last year. We are also at like 3.6 trillion in total spending. I mean, these are big numbers. These are big numbers. And growing, spending growth at 40% year over year. I mean, that's huge. Now, we will soon be getting into the period, like I think last April is when the first stimulus checks from the first stimulus bill went out. So that year over year differential may narrow a little bit, but we're still going gangbusters here. And I stick by this. Look, market, I think right now the market is kind of back into a normal pattern, if you want to call it that. I mean, last year, the reaction to the pandemic, the sort of crash that we had, then this massive unprecedented stimulus, and then that V-shaped recovery. And now I think getting back into more or less of a normal trading pattern where you can see pullbacks. But I stick by my analysis, and that is the fiscal support is extraordinary. I anticipate U.S. GDP growth to be like really, really strong. And, that would suggest the market's going to go higher. I don't see this as a bubble at all. And I've been over this. Earnings are going to be very strong as the economy opens up. So valuations are going to start to look attractive, right? The PE ratio, E in that PE ratio is going to increase significantly. And so the valuations are going to look attractive. Anyway, pullback in oil today down to in the 57 handle. I had my people, my subscribers, either short or on the sidelines looking for that 57 handle. So we got that. I'm not saying what we're doing here. If you want to know, you got to go and sign up for my report, MMT Trader. Dollar. The dollar continues very strong. Again, you're going to have this. I mean, if you look at the dollar index, it went from 104 in March of 2020 all the way down to 89. So what was that? Like a 15 big point decline. and now it went from 89 since like early January up to close to 93 right here. I think 92.90, 92.80. So what, it had like a 4-point recovery on that dollar index. 4-month lows in some currencies like the euro. But I mean, if you look, not if you look, I don't like to say if you look because that's not science, all right? So I retract that. The big picture for the dollar: structural, fiscal deficits expanding, trade deficits. I mean, you got to sell the rallies. That's just the way it is. How far these short, like, here's the thing, and I think I've spoken about this before. In a bull market, corrections, bearish corrections are vicious. I mean, we saw it last March, April with the COVID. We saw it again before that in 2019. We saw it in November, December 2018. They're scary, they're vicious in a bull market. In a bear market, the rallies are scary and vicious too. All right, you get a big concentration of shorts, and then the thing just like a coiled spring, shoots up. And it seems very convincing. It seems like, hey, this is the turnaround, and the arguments also seem very convincing, like, oh, U.S. economic growth, very strong. And I could do a whole very long video on this about how economic growth is not correlated necessarily to exchange rates. I mean, I could give you plenty of examples, but I'm not going to go through that now. But the narratives seem really convincing. Hey, U.S. is going to outperform other G10 currencies and economies. Dollar's going to go up, and you see the reaction in the markets, like the dollar is going up, and it's going up like every single day, and it's like, hey, this is really convincing, and now we're in the king dollar, right? We're seeing all those headlines again. But it was the same thing that happened previously, and before that, and before that. We have it. The dollar is in a slow, meandering downtrend because of structural issues, and it's not a fault of the dollar. It's not like necessarily, a problem. That's just the way it is. The United States has to, or will always have, trade deficits and current account deficits if the rest of the world wants to net save in dollars. And at the same time, it's likely that the United States will always have fiscal deficits because, it's not being financed, quote unquote, and that, that's really the wrong term. And I've explained this. I explained this in my trade, how is a trade deficit financed video a couple of days ago. But anyway, that's it. So, I mean, you gotta, that's the big picture. I like to use the big picture in my overall strategy. And so I sell the rallies, and I just, I wait it out. I'm patient, and I wait it out. I mean, it works for me. What else? Bond yields coming down. Today we got 10-year yield hit 159 and popped back up a little bit. This is what I said. I said this in my videos, over the last couple of weeks. I said, growth does not equal inflation. The hyperinflation narrative was just ridiculous. It's okay for bond yields to come back to pre-pandemic levels. That's where we are at right now. But to see anything beyond that, or to expect anything beyond that, maybe a little bit because the economy is going to be growing, but growth does not equate to inflation. I mean, apples and oranges, two different things. And I said bond yields would start coming down, and that's what's happening. You got to listen to me. So that's it for today, folks. Please don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. What else? Check out my podcast. The link is in the description here, right below. And yeah, if you're not a subscriber to this channel, please like and subscribe. See you tomorrow. Bye-bye.